Okay, guys, so the main function, or one of the functions of the average daily range, the ADR, is that obviously this market here, let's just say this is Australian dollar, US dollar, okay? Now, every day, on average, this is going to trade 100 pips, okay? But the market expands and contracts as we're seeing now with GU and especially the GBP pairs. You know, they're moving 300 to 400 pips a day. Okay, so we would be able to get into, you know, if this is 100 pips ADR from top to bottom. So you know when we use our ADR function to calculate the retracement on our pairs site in when we're calculating our manipulation points, for example, we don't want it to be over 25 to 65% retracement, because then otherwise it becomes potentially a reversal, etc. With the ADR has a different function also, because let's say that we were trying to take a profit of 300 pips, but the ADR is only 100 pips. Okay. Well, that means we're asking price action to do 3 times the average daily. Okay, so in a day trading strategy, that becomes a swing trade. If price action moves 100 pips a day, every day for 2, 3, 4, 5 weeks, 6 weeks, you're asking it to do 3 times the amount that it does every single day in order to get a 300 pip take profit. Right, so it's not going to happen in a day. Now, what we're seeing with GBP pairs at the minute is that they are doing 300 pip moves. But you'll also see that one candle, I seen one candle this morning is 17, 18 pips long. That's a 1 minute candle. So if you're going to try and get into, GU with a 10 pip stop loss, the chances are you're going to get stopped out. So we need to adapt, okay? So the adaptation that I have is basically saying, right, if we're going to do 100 pips a day, our max stop is going to be 25 pips, because that's a quarter of the whole daily move, okay? And that goes the same on GBP USD. If we're going to do 300 pips a day, our maximum stop is going to be 1/4 of the whole daily move, okay? Now, there's nothing to say that we can't get in with a slightly smaller stop, you know, and on a 100 pip ADR, we're more than, and we've done it many times over the last couple of months. We get into something like AU, even GU with a 10 pip stop, and then our risk to reward goes up. And that's the same principle on a wider market. Okay, so when the market swells and it goes up, and let's say we get into the market with a 20 pip stop, we're looking at, you know, 11 to 10R, okay, potential. But we have to allow ourselves to have a maximum and a minimum stop loss, okay? Because if you're going to go into this 100 pip a day market with a 75 pip stop loss, you're going to get 1-to-1. There's not much else that you can do about it. And even then, you're asking it to do 150 pips. So you're asking it to do ADR times 1.5. So you're increasing or decreasing the likelihood of hitting your take profit. So I hope you follow that. I'll do a bit more on this in the coming weeks, maybe. But I'm hoping that the market's going to swell down a little bit, because it's not even overextended anymore. It's just that, you know, if you look at the ADR on GU, for example, let's take a quick look here. ADR, get rid of these things. ADR's here. Average trade daily range. You see this? So the average daily range here on British pound is 374. Okay, sorry, 347. Now, if you go to USD Australian dollar, it's 120. If you go to Australian dollar Canadian dollar, it's 85. So you wouldn't want to use a 75 pips stop loss on something that's trading 85 pips a day. So that's the reasoning behind the madness again. I hope you follow. If not, we'll go through it over and over and over again until you get it. Just follow my lead for now, and I'll speak to you soon, guys.